Investing and trading. You hear these terms thrown around all the time, right? And a lot of people use them like they're the same thing. But they're not at all. In fact, they're two totally different ways of looking at the stock market. Think of it like this. One's a marathon, the other's a sprint. And you really need to know which race you're running.
So, okay, what is the real difference then? That's the big question we're going to tackle today. And we're going way beyond what the dictionary tells you to get to the heart of what really separates an investor from a trader.
Yeah, when you hear the words stock trading, I bet this is exactly the kind of image that pops into your head, right? That controlled chaos of the New York Stock Exchange floor. Traders yelling, papers flying everywhere. For decades, this was the absolute center of the financial universe.
But let's be real. That scene is pretty much ancient history now. Technology has completely, and I mean completely, changed the game. Now you've got these online platforms that let literally anyone trade stocks right from their couch. The market has never, ever been this accessible.
Okay, but here's the twist. Here's where it gets really interesting. Even though it's so easy to get started, and you hear these crazy stories about people making a fortune overnight, there's this constant warning you hear. For most people, trading is something you should probably just stay away from. So why? Why would something that's so accessible be considered so incredibly risky? Let's dig in and find out.
All right, to really get to the bottom of this, we've got to define our terms. We have to be clear on the difference. And you know what? The dictionary's actually not going to help us much here. Surprise!
I mean, look at this. The dictionary says investing is just spending money hoping for a future return. And trading? That's just the act of buying or selling investments. I mean, based on that, trading sounds like it's just a part of investing, right? It's no wonder everyone gets these two mixed up.
So forget the dictionary. The practical difference is what really matters. An investor? They're putting money into something, hoping that the asset itself grows in value over a long, long time. They're banking on that gradual appreciation. A trader, though, totally different story. They're trying to make money from those short-term up and down price swings. They actually need that market volatility to make a profit. See? Two completely different goals.
And these totally different goals mean they're playing two very different games. And where you really see the difference is in two key areas. First, the time frame they're operating in, and second, the kind of analysis they use to make their decisions. And when we talk about time, the difference is just dramatic. I mean, on one end, you have trades that last for just a few seconds. Then you have day traders who are buying and selling all within the same day. They want to be totally flat, zero positions, by the time the market closes. Swing traders might hang on for a few weeks, maybe a couple of months, trying to catch a swing in the market. But investors? They are on a completely different planet. They're thinking in years, sometimes even decades.
Okay, so to understand the next big difference, how they analyze things, we have to talk about this idea of intrinsic value. Now, what is that? Well, it's the theoretical true worth of a company's stock. The idea is that, over the long haul, a stock's price should follow this true value. But in the short term, human emotions, fear, greed, panic, can make the actual market price swing like crazy, way above or way below what it's theoretically worth.
And this right here just lays out the difference perfectly. The investor is all about that intrinsic value. They're digging deep into the company itself, its financial health, its profits, its management, to figure out what it's really going to be worth down the road. The trader? Honestly, they couldn't care less about that. They only care about one thing, the stock price. They're glued to historical price charts and data, looking for patterns that might predict where that price is headed in the next few minutes, hours, or maybe days.
So this leads to a completely different mindset, right? A trader, for the most part, just ignores a stock's intrinsic value. I mean, they might be trading a stock without having a clue what the company even does. Their whole world is just technical indicators, graphs and charts. They are basically pattern hunters, looking for something they can jump on for a quick buck. They're laser focused on any little piece of news that could make the price move right now.
So, okay, we've got these two different mindsets, playing two totally different games. But that brings us right back to our big question from the beginning. Why is the trader's game, this super high-stakes game, seen as such an unfair fight for just the average person?
And let's be honest, the appeal is powerful. You can't deny it. We've all seen those ads online, right? The promise of fast money, the excitement of quick trades, these stories of people going from zero to hero because they found some secret trading formula. It's sold to us as a shortcut to getting rich.
But here's the cold, hard truth. When an average person, an amateur, steps into that trading arena, they're not just playing the market. Nope, they are going head-to-head with seasoned, full-time industry professionals.
And to put it bluntly, it's just not a fair fight. And here's exactly why the odds are so completely stacked against you. First, you're competing against these incredibly sophisticated computer algorithms that can make trades faster than you can even blink. You're up against professionals with gigantic research budgets and teams of analysts. You're trying to make split-second decisions based on scattered information. And on top of all that, traders often use what's called leverage. That's borrowed money, which, yeah, it can make your wins bigger, but way more importantly, it makes your losses catastrophic.
So if it's such an unfair fight, what's the smarter move? What's the better bet for most of us? Well, it really just comes down to playing the odds that are actually on your side.
You know, a really good way to think about trading is that it's a lot like playing poker. For sure, there's skill involved. And yeah, there are professional poker players. But there's also a massive element of luck, and you're sitting at a table with some very, very good players. The odds just aren't in your favor most of the time.
And that really brings us to the final choice, doesn't it? For the average person, investing lets you ride the wave of the broad, long-term growth of the entire economy. It's a bet on progress. Trading, on the other hand, is basically you choosing to walk into a super competitive arena to face really high stakes with odds that are, let's be honest, not great.
And this line just sums it up perfectly, and it's pretty funny too. If you're really looking for that rush of high stakes and not so great odds, you might as well just go to the casino. At least there, they'll give you free drinks. So at the end of the day, it all boils down to this one simple question you have to ask yourself. What's my goal here? Am I trying to build long-term wealth by owning a piece of great companies? Or am I just taking a short-term gamble in a really, really tough game? The answer to that question tells you everything you need to know.